Hey everyone! Welcome to the second video of the Accounting Starter series. This is the second installment in the 5-part series, and today we will be talking about the most common account names used in accounting. As we talked about in part 1, accounting is the language of business, and you can think of account names as the vocabulary or the words that we use in accounting. Our lesson today is divided into two main parts. First, we'll have a brief overview of the financial statements. We'll start off by defining some key concepts, then understanding the purpose of producing these reports, and finally talk about the main types of financial statements. Then we'll move on to the second part, which covers the most common account names used in accounting. We'll start with the account names presented in the balance sheet and then proceed to those presented in the income statement. Okay, so let's begin with the first lesson on financial statements. In this video, we will only be having a brief overview of the financial statements. The detailed discussion, including the preparation, will be presented in a separate video. Now let's start off by defining some key concepts. We'll begin with the three elements of the balance sheet, namely the assets, liabilities, and equity. An asset is formally defined as a resource controlled by the entity as a result of past events and from which future economic benefits are expected to flow to the entity. First thing to note is that it is a resource, like a cash or property or a right, which is controlled by the entity, meaning the company has the right to use or to benefit from the resource and has the ability to transfer or sell it to others. Second, it is a result of past events, meaning you obtain the asset because of an event that has already occurred, and the receipt of the asset is not based on a future event which may or may not happen. Third, future economic benefits are expected to flow to the entity. This means that in some way, the company is expected to benefit from the use of that resource. Next, we have liability, which is formally defined as a present obligation of the entity arising from past events, the settlement of which is expected to result in an outflow from the entity of resources embodying economic benefits. First, it is a present obligation, meaning a duty or responsibility that should be performed by the company. For example, paying cash, providing services, or delivering goods. Like assets, the obligation should arise from a past event and not something that will occur in the future. Third, an outflow of resources is expected, meaning the company will make use of its resources to settle the obligation or to fulfill its responsibility. For example, the company will use its cash resource to pay off its bank loan, the obligation. Third is equity, which is formally defined as the residual interest in the assets of the entity after deducting all its liabilities. So here we see that it's just the remainder, the remaining assets after paying off or settling all the liabilities. It is the portion the owner is entitled to after settling all the obligations to third parties. Equity also includes any transactions relating to the owner, like investments and withdrawals. Personally, I like to think of equity as the company's liability to the owner or what the company owes the owner. Later on, you'll notice that liabilities and equity have some similarities, especially in journalizing. So again, this is just a personal understanding and is not a formal definition. Next, we have the elements of the income statement, namely income and expense. These terms may be familiar to most. Income would pertain to the earnings, or kita in Filipino, while expense would pertain to costs incurred or spendings, or simply gastos in Filipino. But now we will look at the formal definitions. Income is formally defined as increases in economic benefits during the accounting period in the form of inflows or enhancements of assets or decreases of liabilities that result in increases in equity other than those relating to contributions from equity participants. You'll notice that the definition of expenses is actually quite similar with the definition of income, only it is the opposite. Here, expenses are decreases in economic benefits during the accounting period in the form of outflows or depletions of assets or incurrences of liabilities, meaning you use up the assets or you have additional obligations that result in decreases in equity other than those relating to distributions to equity participants. Let's try to understand this part by part. First, for income, increases in economic benefits during the period in the form of inflows or enhancements of assets or decreases in liabilities. This just means that income measures the benefits received by the company during a specific period, for example, January 1 to December 31, 2020. And these benefits may come either in the form of increases in assets or decreases in liabilities. If we take a look at expense, the definition is the opposite. Expense measures the decrease in benefits, so something the company gave up during the period, which can either be outflows or depletions of assets, for example, payments using company assets like cash, or incurrences of liabilities like having additional obligations to pay. Now let's look at the last part of the definition. Earlier, we defined equity, and you'll recall that we mentioned equity includes the investments and withdrawals of the owner. So this part here, contributions from equity participants, pertains to the investments by the owner, who is the equity participant, while this part here, distributions to equity participants, pertains to the withdrawals made by the owner. So going back to the definition of income, here we see that result in increases in equity other than those relating to the contributions from equity participants. So this part here simply tells us that income also increases the equity or the amount owed by the company to the owner, but excludes the additional investments, which also increases the equity balance. Expense, on the other hand, decreases the amount owed by the company to the owner, but also excludes the withdrawals made by the owner. So why does income increase while expense decrease the equity or capital balance? Because if you think about it, any income earned by the company will eventually go to the owner. So the company records the additional income as an additional amount to be paid to the owner, which is represented by the capital or equity account. Now let's talk about the purpose of preparing the financial statements. Recall that one of the steps in the accounting cycle is to prepare these reports for users and decision makers. And we've also said that this is the main goal or the end product of the accounting process. So why do we have to perform this step? First, we do this to summarize the information we've collected from the previous steps and make them more useful for decision making. Second, since accounting is the language of business, by creating these reports, we are actually communicating this information to the users. Third, such information can be used by the users, which we discussed in part 1, for making decisions depending on their needs. Alright, so now we'll talk about the 4 main types of financial statements, which we collectively refer to as the face of the financial statements. Again, this will just be a brief overview, and the detailed discussion will be posted in a separate video. So these financial statements are the statement of financial position, the statement of comprehensive income, the statement of changes in owner's equity, and the statement of cash flows. First, we have the statement of financial position or the balance sheet. So this provides information about the financial condition of the company, its assets, liabilities, and equity. The amounts presented here are balances at a point in time, a specific date like December 31, 2020. For example, it tells us how much cash the company has on December 31, 2020. Here is an example of the statement of financial position or the balance sheet. Here we see two main sections. We have the assets on top and the liabilities and owner's equity below. Assets are further subdivided into current and non-current assets. Then under each category, we see the specific account classifications like cash and cash equivalents, trade and other receivables, merchandise inventory, and so on. So these are the common classifications, but these may also vary among companies depending on the assets owned and liabilities owed by that specific company. Another thing to note is that assets must always equal the total liabilities and owner's equity. There should be balance between the two, and this is why it's called the balance sheet. Again, the balance sheet presents the amounts as of a point in time, in this case, December 31, 2020, and this is indicated in the header on top over here. The second financial statement is the Statement of Comprehensive Income or the income statement. This provides information about the company's financial performance, the income and expenses for a specific time period. So unlike the balance sheet, which provides information as of a point in time, the amounts reported on the income statement are for a specific period of time. For example, a year ranging from January 1 to December 31, 2020, or a month like January 1 to 31, 2020. Here is a sample of an income statement for a service type business. All revenues or income are listed first, followed by all the expenses. Then, deducting all the expenses from the total income would provide us the net income or loss for the period. Again, the income statement presents amounts for a period of time, in this case, for the period ended December 31, 2020, which is also indicated in the header over here. Here is another sample of an income statement which is used by merchandising businesses. So unlike the previous income statement, here we have additional information which is specific to merchandising businesses. We have net sales, the cost of sales, and gross profit. Expenses are also grouped according to their functions, like general and administrative expenses, distribution expenses, other expenses, and finance cost. But similar to the service type business, we still deduct the total expenses from the total income to get the net income or loss for the period. Third, we have the Statement of Changes in Owner's Equity or the Statement of Changes in Equity. This report presents information about changes in the owner's capital account. This includes investments and withdrawals by the owner and the net income or loss for the period. Like the income statement, the information presented is for a period or range of time. Here is a sample of the Statement of Changes in Equity. Here we have the beginning balance of the owner's capital account as of January 1. Then we see the changes in the capital account during the period. The net income and additional investments by the owner are added to the January 1 capital balance, while the withdrawals made by the owner are deducted to get the balance as of December 31. Fourth is called the Statement of Cash Flows or Cash Flow Statement. From the name itself, it provides details about the cash flows of the company, the cash inflows or receipts, and the cash outflows or payments. The cash balances at the beginning and end of the period are also presented here. The details presented also cover a period of time, just like the income statement and the Statement of Changes in Owner's Equity. Here is a sample of the cash flow statement. You'll notice that the cash activities are classified into three main types: the operating, investing, and financing activities. We'll discuss the differences among the three in a separate video. The transactions resulting in cash inflows and outflows are listed under each type of activity. In addition to the face, we also have the notes to financial statements, which is sometimes simply referred to as the notes. These contain additional details to support the information presented on the face. For example, here we have the first part of the notes to financial statements. The first note provides the breakdown or details of the other income account presented in the income statement. This is labeled as Note 1, and if we look at the income statement, we'll see that there's also a tagging here, so other income is also tagged as Note 1. The other income is cross-referred to Note 1 of the Notes to Financial Statements. The notes presents the specific accounts included under other income, such as rent income, interest income, and so on. In addition to the breakdown or composition of accounts, notes to financial statements may also include narratives like the company information and accounting policies. Now we're moving on to part 2 of our discussion today, and we will be talking about the account names. Please note that the list of accounts to be discussed here is not exhaustive, so we can't cover all the accounts, but these are the most common ones and would more or less be sufficient to cover for basic accounting. Account names are the specific words used in accounting to standardize or to increase the uniformity. For example, there are several ways to pertain to money. You can say currency, bills, cash, and so on. But since accounting is a system, there are standardized words which are used to refer to specific items. In this case, we officially use the term cash to refer to money. So just like learning any new language, before you form sentences, you need to build up on your vocabulary. And this is actually the same thing. So mastering the account names will definitely help you in the upcoming topics, especially when analyzing transactions in Part 3 and journalizing in Parts 4 and 5. I highly encourage everyone to spend more time mastering these accounts. And here are actually some tips to help you. First, you need to understand the meaning of account names. A lot of the account names already indicate the meaning or the purpose of that account. For example, the receivable account, able and receive. You are able to receive, so it is used to record something that you are bound to collect in the future. It's important that you understand how account names are formulated so you can come up with an appropriate account name when you are faced with a new or unfamiliar transaction. Don't just memorize, because memorizing will not help you when you're analyzing transactions. You still won't be able to identify which account to use if you don't understand the purpose of that account. Eventually also, if you continue memorizing without understanding, you're going to end up forgetting them anyway. Second is familiarity. You need to go over these account names repeatedly. Practice journalizing frequently so that eventually it will become a part of your system and you'd be able to think of the appropriate account name very quickly. Third is retention. I highly encourage everyone not to take screenshots. It would help you greatly if you make your own notes because handwriting can help you in remembering. You can also summarize the accounts in a way that will help you remember them better. Highlight those accounts which are new to you or which you tend to forget, and doing so will help you master them a lot quicker. I've presented the account names according to their classifications in the balance sheet, namely current and non-current assets, current and non-current liabilities, and equity. However, these will be discussed in detail when we are talking about the financial statements. For now, you don't need to fully understand them, and we will just be focusing on the account names and their meanings since this would be needed for parts 3 to 5. Here is an overview of the common account names classified under current assets. The accounts in the shaded boxes are the account classifications presented on the face, in this case, the balance sheet. The ones in the clear boxes are presented in the notes and are the specific account names used in journalizing. Those in shaded boxes without sub-accounts are also the account names used in journalizing. So for example, cash and cash equivalents would be presented on the balance sheet, while cash on hand, cash in bank, and cash equivalents would be presented in the notes. Account names used in journalizing would be these three as well. But for merchandise inventory, there are no sub-accounts, so this would be presented as a line item on the balance sheet and is also the account name used when journalizing. Now we'll go through them one by one. First, we have cash and cash equivalents. This is composed of cash on hand, cash in bank, and cash equivalents. Cash on hand is literally money that you have on hand, bills and coins, including checks that have not been deposited in the bank. Cash in bank pertains to money deposited in banks, so these may include money in current or savings accounts. For basic accounting purposes, we generally just use the account name cash. Cash equivalents is an advanced accounting concept, so we won't discuss this in detail here. But for basic accounting, you just need to know that it's a type of investment which is highly liquid and easily convertible to cash. Next, we have investments in financial assets at fair value through profit or loss, or simply FAFVTPL. Details will be discussed in an advanced accounting subject. So for now, you just need to know that these are investments held for trading purposes, for short-term profits or gains. Third, we have trade and other receivables. From the name itself, receivable, receive and able. So something that you are able to receive. So these pertain to the company's right to collect amounts from various persons or entities like customers. So there are specific types of receivables for specific transactions. First is accounts receivable, which pertains to amounts to be collected from customers. So sometimes the company can provide services on a specific date, but the customer will choose to pay at a later date, let's say 1 week later. So during this time, the company cannot record cash since it has not received the cash payment. But as of that moment, the company has the right to collect from the customer in the future, and this right to collect is recorded as the accounts receivable. The allowance for doubtful accounts is the portion of accounts receivables which are not likely to be collected. So doubtful accounts because they are doubtful of collection. The negative sign here indicates that this amount is deducted from the total accounts receivable balance. Note receivables are receivables in writing, meaning it is supported by a document or instrument called a promissory note. A promissory note is a document where one party, called the maker, promises to pay a determinate sum of money to the payee at a specified date. For note receivables, the company is the payee. Next, we have loans receivable, which pertains to amounts that the company has lent to other borrowers. Advances to employees pertain to the company's receivables from the employees arising from cash paid in advance to such employees. Next, we have accrued income, which pertains to income that has already been earned but not yet paid. This means that the company has already provided the service or already has the right to the income but has not yet collected the payment. So in essence, accrued income is a receivable. So you can just fill in the blank with the nature of the transaction. For example, you can have accrued interest income for interest on notes receivables, or you can also have accrued rent income if the transaction pertains to rent to be collected from your tenant. Instead of accrued rent or accrued interest, you may also use the terms interest receivables and rent receivable. So receivable is actually the general account name to refer to a transaction where the company has the right to collect from another entity in the future. You can simply replace the blanks with the term appropriate to the nature of the receivable or transaction to make it more specific. Next, we have merchandise inventory. So a lot of you may already be familiar with this. This simply pertains to the goods held for resale by the company. Next, we have prepaid expenses. So from the name itself, prepaid, pre means in advance. So these are expenses that have been paid for in advance. These include the office or store supplies like a ream of papers. You buy them first and gradually use them while the business is operating. Another example would be paying for next month's rent in advance. In that case, it would be called prepaid rent. So you can simply add the word prepaid to the nature of the transaction like what we did in receivables. For example, we have prepaid advertising or prepaid insurance. Now we have the property, plant, and equipment, or PPE for short. PPE is further subdivided into account names, which is specific for each type. Land and building are quite self-explanatory, and I won't go into details anymore. Office or store equipment would include computers, printers, fax machines, and so on. If these are used in the office, they are called office equipment, and if they are used in the store, they are called store equipment. Transportation equipment refers to the vehicles for transportation like cars, trucks, or vans, and so on. Office or store furniture and fixtures pertain to movable furniture like sofa, tables, chairs, and fixtures like shelves and filing cabinets. Similar with the classification earlier, if these are used in the office, they are called office furniture and fixtures. If these are used in the store, they are called store furniture and fixtures. Last is machinery, which is also quite self-explanatory. So this would include machines like those used in the factory, for example, production machines or packaging machines. Now, each PPE account is paired with the corresponding accumulated depreciation account. This will be discussed further in future lessons, but to give you a brief idea, this is basically an account which reduces the value of the property and equipment because of factors like usage, time, and so on. For example, a new building would more likely be in better condition now than 5 years from now. So its value is likewise expected to decline, and that decline is represented by the accumulated depreciation account. Note that there is a negative sign here, meaning this is a contra asset account, and this should be deducted from the related asset balance. For example, accumulated depreciation building should be deducted from the building account, and so on. Note that the name of the PPE should match the name of the corresponding accumulated depreciation account. Another important thing to note is that land is the only PPE that is not depreciated. So we don't have an accumulated depreciation account for land. This is because we expect its value to increase continually in the future. Also, an additional info, which is a common mistake of a lot of students, equipment and furniture do not have a plural form. So please do not write equipments or furnitures. They are both grammatically wrong. Next, we have notes receivables and loan receivables, which are the same as the ones we discussed earlier. So this is just a difference in classification because these can either be classified as current or non-current assets, but we'll talk more about these classification differences in future videos. Now we'll move on to the liabilities. This is generally composed of amounts owed to third parties like creditors, suppliers, employees, and so on. The first is collectively referred to as trade and other payables. This is kind of like the opposite of receivables. Again, from the name itself, payable, pay and able, so something that should be paid by the company. Accounts payable pertains to amounts owed to suppliers. We also have accrued expenses, which is kind of the opposite of the accrued income we discussed earlier. So if accrued income pertains to income already earned but not yet collected, accrued expense pertains to expenses already incurred but remains unpaid. An example would be the electricity bill. If we receive the bill for January 2020 in February, then as of January 31, we've already consumed the electricity but the bill is still unpaid. So this is what we call accrued expense. In this example, we can refer to it as accrued utilities expense. Just like accrued income and receivables that we discussed earlier, accrued expense and payables can also have different variations depending on the nature of the specific transaction. So we can have accrued interest expense or interest payable, accrued rent expense or rent payable, and so on. If you encounter a new transaction where the company owes cash to another person or entity, then you can simply formulate the appropriate account name using this format. Next, we have advances from employees. So you'll notice that this is the opposite of advances to employees that we discussed earlier under receivables. Again, let's analyze the account name. Advances from employees, meaning the advances came from the employees. The employees were the ones who made the advance cash payment for the benefit of the company. This would include the advance payments made by the employees while performing their duties for the company. This also means that the company owes the employees money and must pay them back in the future, and this is why it's also classified as a payable. Note payable is similar with the concept of note receivable, which we discussed earlier. Only now, the company is the maker of the promissory note, and the company will be the one making the payment in the future. Next is deferred or unearned income. Deferred means to postpone or to delay, so this means that the income is delayed or not yet earned. This refers to cash paid in advance by the customers for which the income has not yet been earned by the company, meaning the related service or the related goods have not been provided. You may use deferred income, deferred revenue, unearned income, or unearned revenue, and they would all refer to the same thing. Next, we have liability on discounted notes receivable. This would be quite difficult to define now since you're only starting out, and this should be discussed in a separate video in the future. For now, just take note that this is under current liabilities, and it's also classified under trade and other payables. Under current liabilities, we also have mortgage, bonds, and loans payable. Mortgage payable refers to the type of loan used to finance the purchase of property like land and buildings. Bonds payable pertains to long-term debt issued by corporations which are supported by bonds. As the issuer, the company makes a formal promise to pay a specified amount at a specified future date. This is similar to the concept of notes payable, only instead of being evidenced by a promissory note, this is evidenced by a bond certificate. And then we have loans payable, which pertains to amounts borrowed by the company from third parties like banks. Now we have non-current liabilities. So under this classification, we have mortgage payable, bonds payable, and loans payable, which are the same as the ones we discussed earlier. So again, this is just a classification difference between current and non-current liabilities, which will be discussed further as we talk about the financial statements. Last, we have the owner capital and owner drawing account. So these accounts are used when there is a transaction involving the owner. Owner capital is used to record additional investments made by the owner, while the owner drawing account is used to record any withdrawals made by the owner. The word owner is replaced by the name of the business owner. So for example, Juan Capital or Juan Drawing. Alright, so now we're moving on to the income and expense accounts. Words commonly used to indicate income are revenues, sales, income, and gains. So if you see these words, they are likely to be considered income. Exceptions are if you see dua in front of the word income. So dua means deferred, unearned, or accrued. Accrued income is again a receivable and it's an asset, not an income. Unearned and deferred mean the same thing, and these are both classified as a liability. Words commonly used to indicate expense are expenses, losses, and costs. So if you see these words, they are likely to be considered expense. Exceptions are if you see PA, prepaid and accrued. Prepaid expense is again a form of asset, while accrued expense is a payable and is classified as a liability. Now, when should we record income and expense? Income is recorded at the point or on the day when services have been rendered or provided, the goods have been delivered to the customer, or any indications that a gain or income has been earned. Expense, on the other hand, is recorded at the point or on the day when the services have been used or consumed by the company, when the goods have been received, or any indications that a loss has been incurred. Now, here is a list of the common types of income accounts. We have net sales, which pertains to income from the sale of goods. This is computed as the total amount of sales made by the company, less any sales discounts and sales returns and allowances. We'll discuss them more in Part 5. Then we also have service revenue or service income, which pertains to income from providing services. Other types of income include dividend income, which is the earnings received by the company on its stock investments. Interest income is the earnings from investments or receivables. We also have miscellaneous income, which is composed of various types of income, which are rather small or immaterial in amount, so they are lumped together in one account, which is the miscellaneous income account. Mark-to-market gains and gains on fair value changes are gains due to increases in the value of investments. This is an advanced concept and will be discussed in advanced accounting lessons. So you'll notice that there are a lot of variations for income depending on the nature. You can also have rent income, gain on sale of land, and so on. Now let's move on to the expenses. First, we have cost of sales. We'll talk about this in detail in Part 5, but the account names used in computing for the cost of sales are merchandise inventory beginning, purchases, purchase discounts, purchase returns and allowances, freight in, and merchandise inventory ending. Purchases pertain to goods purchased or bought by the company. Purchase discounts and purchase returns and allowances are reductions in the cost of purchases due to discounts and returns, respectively. Freight in or transportation in pertains to the shipping costs relating to the purchases. Take note that the merchandise inventory account is a balance sheet account and is considered an asset. It's only used in the formula for computing the cost of sales. Other types of expenses also include salaries and wages expense, office salaries, sales salaries, and employee benefits expense. Depreciation expense is the expense relating to the property, plant, and equipment for the current period. Just like the accumulated depreciation account, the depreciation expense is matched with the corresponding PPE's account name. For example, depreciation expense building, depreciation expense office furniture and fixtures, and so on. We'll talk more about depreciation in the future lessons. Here are other common types of expenses. We have utilities expense, like for the usage of water and electricity, commissions expense, doubtful accounts expense, which is the expense relating to accounts that are doubtful of collection. We also have taxes and licenses expense, like registration fees, property taxes, and so on. Rent expense, insurance expense, transportation expense, repairs and maintenance, gas and oil, miscellaneous expenses, which are various types of expenses in small amounts that are lumped together in one account. Finance cost or interest expense, like interest on bank loans, other expenses like loss and sale of assets like land or PPE. You'll notice that you can also have different variations of the expense account just by indicating the nature of the transaction and adding the word expense. Now it's time to check our knowledge and understanding of the account names we just learned. Identify the specific account names being described by the following. You can choose from the list that we discussed earlier. First is very easy. Money deposited in banks. The correct answer is cash in bank. 2. Expenses paid for in advance. Paid for in advance, so this is prepaid, and since it's an expense, the correct answer is prepaid expense. 3. Promissory note received from a client. Since there is a promissory note, we know that this can either be a note receivable or a note payable. So now we'll just have to check if the company is the maker or the payee. Since this note was received from a client, the company is the one collecting the payment. So in this case, it's a note receivable. 4. Outstanding accounts from customers. Outstanding accounts mean unpaid balances, so this is something that we are supposed to collect from the customers in the future. So the correct answer is accounts receivable. 5. Outstanding accounts due to suppliers. This is very easy, so it's similar to the previous item, and this pertains to unpaid balances to our suppliers. So the correct answer is accounts payable. 6. Unpaid employee salaries. Okay, so what account do we use for anything that is unpaid? We use payable. Since this pertains to salaries, we can make the account more specific into salaries payable. Another possible answer would be accrued salaries expense, since this is an expense already incurred but still unpaid. Okay, hope you guys are getting the hang of it. Now let's move on. Supplies used during the month. We see the word used, so this means that this would be an expense account. And what type of expense would it be? Supplies. So the correct answer is supplies expense. Next, services rendered to clients. Again, there is a service involved. Since it was rendered or provided by the company, this would be an income account. And what specific type of income? Service income or service revenue. Rent paid for in advance. Something paid for in advance is prepaid. And what type of prepayment is this? Rent. So the correct answer is prepaid rent. Next, interest earned on investments. We see the word earned, so this indicates that it's an income account. And what type of income? Interest. So the correct answer is interest income. Next, we have interest earned but not yet received. So in this case, you already have the right to the interest since you've already earned it, but you have not yet collected the payment. So this must be a right to collect interest in the future. And that definition tells us that this account is a receivable. This is also the definition of an accrued income. So the answer here is interest receivable or accrued interest income. Computer used in the office. So this is very easy. The answer is office equipment. If instead of office, the computer was used in the store, then the answer would be store equipment. Okay, next, electricity used during the month. Again, we see the word used, so this must be an expense. And what type of service was used? Electricity. So the correct answer is utilities expense. Moving on, stocks or goods for sale by a store. The correct answer is merchandise inventory. Next, bank loan due to ABC Bank. So this is a loan which is due to or should be paid by the company to ABC Bank. Since this is something that should be paid, we know that this is a payable. And what specific type of payable is this? It's a loan. So the correct answer is loans payable. Bills and coins on hand. This is again very easy. It's simply cash on hand. Next, unpaid mortgage on company building. So we have unpaid, which indicates that this is a payable. And what specific type of payable? Mortgage. So the answer is mortgage payable. Last, we have advertising fee for the next 6 months paid today. So this is a payment made in advance, meaning this is a prepaid expense. And what specific type of prepayment? Advertising. So the correct answer is prepaid advertising. So that's the end for the first part of our concepts application. And now let's move on to analyzing transactions and identifying which account names are affected. To identify which account names are involved, try to answer these two questions. How did the company benefit and what did the company give up? Because we're assuming that in every transaction, there's a give and take relationship. You receive something in exchange for something you give up. So the company may benefit by receiving assets, decreasing its liabilities or dues to the owner or capital account, or through the use of a service or incurring an expense. In exchange, the company may give up assets, incur more liabilities, or increase its dues to the owner, or provide a service or deliver goods, which is represented by the income accounts. Now let's try applying this analysis on the following transactions. 1. Purchased a computer for 20,000 pesos and paid cash. Again, we'll analyze by asking two questions. First, what did the company receive or how did it benefit? Here, the company received a computer. The appropriate account name is office equipment. Now, what did the company give up? The company paid cash, and the account name is also cash. So the accounts affected here are office equipment and cash. 2. Rendered services amounting to 15,000 pesos on account. So what did the company give or provide? Services. And the account name for that would be service income. And what did the company receive? Normally, the company would have received cash as payment. But here we see the term on account. So this means that the company was not yet paid, but has the right to collect in the future. And this pertains to accounts receivable. So the accounts affected in this transaction would be accounts receivable and service income. 3. Obtained a bank loan amounting to 50,000 pesos. Here the company took out a loan. So what did it receive? It received cash. And what did it give in exchange? It promised the bank payment in the future, and this promise is recorded through the loans payable account. So the accounts affected in this transaction are cash and loans payable. Last, we have received bill for electricity used during the month. Here we see electricity was used, and this would indicate that the company benefited by using the service. And this is recorded using the expense account. In this case, utilities expense. What did the company give? Did it pay cash? Not yet. It only stated that the bill was received, indicating that no payment has been made as of the moment. Instead, the company has the obligation to pay or a promise to settle the bill in the future, which is a payable. In this case, it's referred to as the utilities payable. So in this transaction, the accounts affected are utilities expense and utilities payable. And now we've reached the end of the video. So thank you guys for sticking until this part. And if you're feeling overwhelmed, don't worry, we've all been there. I assure you that it will only get easier in the future once you start mastering these concepts and applying them in the next lessons. That's it for today's lesson. I hope everybody learned something new. Please don't forget to like, share, and subscribe to our channel. And if you have questions or requests, feel free to comment down below. And I'll see you all in our next video.